Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Ryan Detrick. He's the Chief Market Strategist at LPL Financial. We're going to take a look at if a Democratic sweep could really impact the markets and what that means. But Ryan, before we get into that, let's take a look at the performance so far this year, because it certainly is unprecedented, and what it could mean for the longer term and possibly next couple of months.
Yeah, I mean, you think about the S&P's like flat for the year, right? But I mean, we've had this, the Nasdaq was up 20% for the year, okay? So it's just an unbelievable year. But what we've been saying is, yes, we also know the first quarter was down 20% for the S&P, second quarter up 20%. The strength that we've been seeing, the unbelievable best 50-day rally ever, one of the best second quarters we've ever seen. It sounds crazy to think this, but those are the hallmarks of actually the starts of new bull markets. They usually take place after a sell-off, but that incredible strength is something that the market's telling us that there could be continued strength. Think about this. S&P up 20% last quarter, right? You look in history, when it's up 15% a quarter, it only happened 8 times since World War II. The next quarter was higher every single time. The 2 quarters later, higher every single time. So there's some serious momentum going on here, and the 4 most dangerous words are this time is different. We hear that all the time, saying, oh, this time is different because it's obviously a 100-year pandemic. We're not minimizing that, but the market is telling us something. This much strength to us is probably going to resolve higher in the future.
Now, there's talks that a Democratic sweep is a real possibility and that it could be bad for markets, but is that really what history shows?
Well, no, I mean, it's not. When you look back at history, when you have a Democratic sweep, that year, the S&P has actually been higher about 13% on average, only down 3 times. And there's over about 20 different years or so approximately where you had a Democratic sweep. So to blindly say, if it's a Democratic sweep or Republican sweep, too much power in Washington is obviously what kind of worries people. But if you just simply look back when there's Democratic sweeps, the markets tend to do pretty good. In fact, better than average. And really, we just released our 2020 mid-year outlook, and what we found, the best scenario is actually that divided Congress, right? Kind of how our 4 founders wanted it, not too much power one way or the other. There's the last 10 years, you had a split Congress. The S&P has actually been higher. This could be the 11th year. So bottom line, if you have a split Congress, that's probably the best scenario potentially for your investments. But should the Democrats split, like we've been seeing kind of in the polls all of a sudden the last 2 months or so, that's not a blindly reason to just sell and get out because you're fearful. History says maybe markets will do just fine.
Ryan, let's talk about the economic recovery, because as you said, the stock market is continuing to show that strength and that momentum, but there are some pockets of improvement in the economy. But the fact of the matter is unemployment is really high. We don't know what stimulus packages are going to look like and how that's going to continue. Some of these jobs just simply won't be coming back, and that's going to impact everything from oil consumption to consumer sentiment, and that's a big part of our GDP. So how much longer do you think we have to go until the economy starts to look like what the market is doing?
Well, the sad truth is probably a while, right? You look back at market history, to get jobs back, for instance, it took 4 years for the jobs to come back after the tech bubble financial crisis, tech bubble recession. 6 years for jobs to come back during the great financial crisis 12 years ago. So that's going to take a long time. And the market is clearly high priced here, right? We've had this big rally. I mean, it's priced for perfection. And it really is saying there could be a better economy ahead. But LPL research, yes, we think this recession is probably over right now. Maybe by next month it'll be over. But that doesn't just mean the economy is going to be ripping here higher the second half of the year. Everyone says, what shapes the recovery? We're going with the square root recovery, right? This is the easy part. This is the easy part of the recovery off the lows. Now it's probably going to go sideways and be a little bit tougher than most people think. As we see, different parts of the country are kind of shutting back down, or at least putting different rules in place so people stay apart and don't spend as much money potentially, like you said, with the consumer. So those are all those worries. And then, of course, we get to the winter months and when things could be even a little bit worse. So we're out of the recession probably, but it's going to be a little bit weaker recovery, we think, second half of this year than most people probably expect.
Ryan, great to have you with us as always. Thanks for joining me on Trade Talks.
Appreciate it. Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.